All right, guys, welcome back to another episode of Chart Talk. As always, we're going to go over the major markets, key sectors, and top swing ideas for the week ahead. Again, if you don't know anything about big picture trading, if you're ever interested in looking to enhance your swing trading and long-term investing skills, just visit our site, bigpictureswingtrading.com, to learn more about how we can help improve your trading. So let's jump right into it. Again, we had a little bit of a tiny sell-off last week. This little, very small, kind of pull in where again, we've been in this very clear channel for many months now with support being tested a handful of times. And of course, again, resistance being tested along the way. Now, every time we get the resistance, it's extremely obvious as a sell signal. And each time it comes down to support, it feels like the trend is over. But in the index, we have a very clear sign of when we want to de-risk from an active trading standpoint. So pretty much since September, the S&P has been supporting this 650 area, has not been able to break. And last week, when we had that pull in the last 2 weeks or so, we pulled into support, kind of shook out this little area, and we had a nice close on Friday, and we had the subsequent gap up today. So we're still in this trend until this trend breaks. The trend's our friend. But the real key out, if or whenever this trend changes, is going to be a break below 650 in the SPY. For now, everything looks good. Everything's pushing higher. We're seeing the same action in the Qs. Again, same channel, same little shakeout on Friday, same gap up. And again, if we continue on higher over the next week or so into this, visual line of resistance, everything is all good in the world. And again, same key exit like we're seeing in the Qs, same thing we're seeing in the SPY. Pretty much this is the area that we want to keep an eye on. As long as we stay above this area here, this 590 in the Qs, again, all good. So again, Dow 30, same thing. I'm not going to keep repeating the same story. And we saw a little gap up in gold coming into this week. Again, this key area of support, just like we're talking about with the S&P and the Qs, you want to see these key levels of support to hold. If this area breaks, or when it does, expect to see, a breakdown back to retest the prior breakout area. Now, for now, probably get a dead cat bounce. You probably get a run up back to 4,000 an ounce in gold, and we'll start to see a potential bull flag forming over the next couple of months in this very wide range. So moving on, again, we have the 10-year. Again, we had those back-to-back rate cuts. You typically will see the fade in the 10-year. Again, still in this broader range, and we really want to see this break of this, we'll call 4%, 3.9. Really want to see that break here in time for that move back into the longer term trend line closer to like 3%. Again, for anyone trying to take on debt and we see this break, you'll see interest rates come down, and that's what you want to wait for. Again, dollar has been basing out for the past few months now and has been somewhat rallying off those lows in September, running into this key resistance area. Now, again, weak dollar is good for stocks, strong dollar, not the best for stocks. So right now it's kind of in limbo, just in this base, and a break above this would not be good for the market. We fade back into the range, very good for the market. So it's good to see that this wasn't a massive break here, just kind of a little push through and faded back in. So hope to see the dollar continue to fade, and that should continue to push equity prices higher. So moving on to some sectors, again, semis have been the key leader in this rally. This highlighted area has been macro resistance. I'll switch to a weekly, and we can see semis the last few weeks have been trying to form this, trying to turn this resistance area into support. And if it can do that, amazing. If not, again, we're talking about these key exits in these indexes and major markets, knowing when to get out when the party's changing. So for now, semis are up nearly 100% off the lows from April. And the path of least resistance seems to be higher, but when they do get a bit extended up here, we want to know where the exit is. So if we see this break down to this weekly low here, that will be the sign to kind of get out of Dodge. Healthcare has been very strong. Biotechs also have been very strong. We were talking about this last week. If you look, it's almost like a mirror. The weakness, the basing stage to the breakout stage. So for now, bios are just in this tight channel, working their way back to all-time highs. Tech names have been very strong. Industrial names, again, this is a weekly patterns. You see this nice little flag here. It's a nice upper channel. Industrials look great. Consumer discretionary is probably one of the more developed chart patterns out there sector-wise. Again, we have this all-time high. We have the retest, still acting as resistance still, but a nice flag has been forming, and we should expect that breakout to new all-time highs coming very soon. Again, REITs were also another strong sector, bouncing off of support last week, but in this very tight, wedge pattern that's been forming. So not expecting fireworks out of the REIT space, expecting just a bounce, back into this resistance trend line, but they've been strong nonetheless. A couple sectors setting up, again, telecom just starting to flag out here. Same with the mid and small caps, just big flag that's been forming. Same thing with small caps, big flag that's been forming here. And also energy stocks been flagging out for the better part of the last half year. So some sectors are setting up, some sectors are quite strong, and there's a few key sectors we want to avoid. Main one right now has been the staples, and we want to wait until we see a break or a shakeout of this key support area. Again, I'll switch over to a weekly. So staples, avoid until we see a test of this trend line. Materials also have been very weak. Got a little bounce back last week, but overall, just very weak action in the material space. And financials, we're talking about this, and we'll talk about this a bit later with some of the individual names. We're seeing the same breakdown stage that we saw at the beginning of the year, repeating itself, but it's not as dramatic, it's not as weak. It's more of just consolidating the massive run-up the financial sector has had over the past couple of months. And it's more just giving it time to really form more of a broader flag here. So there's that insane weakness in financials, but we still want to just let this pattern base out and then wait for the next entry to buy back their highs. So we'll move on a couple names. Again, we've been in this Tesla for about 2 months now, up about 20% in the name. It's run back up to that retest area. Again, we talked about consumer discretionaries, basically very similar chart pattern. Consumer discretionaries was at all-time highs. Sector has worked its way back to retest those highs, like we're seeing with Tesla. And for now, we're waiting for that momentum buy through 470 versus 400 for that move to 540. So this breakout should push consumer discretionaries higher. And we just need to be patient and wait for this pattern to develop more to buy through that breakout. A name we got into today, again, talking about some of the healthcare names being somewhat strong lately. Again, if we zoom out a little bit here, we can see this BSX. The key breakout is this 108. So 108 has not been able to break all year. It's been setting up for quite some time now. It had that shakeout move recently. Again, it was super tight here. We were keeping a close eye on it, but it wasn't ready. It has broken down and started to base back out. And instead of having to be perfect at 108, whenever that time comes, recently we saw this base forming under 100. Had a little breakout last week, kind of pulls back in. And now we're seeing that higher low. This whole time here, when it's setting up under 100, the out is 94, $6 risk. Breaks out through 100, comes back, breaks under 100, and the 200-day is starting to now act as support. Where the previous time it was trying to break 100, the 200-day was above it, pretty much creating resistance. Now, this 200-day is starting to act as support. So it's giving us a very tight risk entry. We bought in today through 100. The stop was versus the 200-day, pretty much $1 risk here. Real pivot, just to give it some room, is versus 98. So really 1 or 2% risk, depending on what you're trying to give it. And for now, the shorter term target is a run up back to 108. Now, we still are expecting that major breakout at the level, but for now, we're just going to take this trade one step at a time. So right now, we're risking 1%, looking to make 8%. That's for now. And then that next setup, we can circle back to it when that time comes. And that's something very similar to what we've been doing with Walmart, where we know this major breakout is this 104 level, but yet we still have taken quite a few trades in it successfully. We bought 100, we sold 105 or 104. We bought back 97, and then we were selling in that 103, 104 area. And now, Abby was one who took it again to those 104, took profits into 110, and now we're starting to see this 100 act as support as the 200-day is catching up, which has been acting as support for many months now. So there's a potential trade again in Walmart through this 104. If we do get a breakthrough that, again, stops versus 100, and the target is going to be somewhere kind of in the 115, 120 area. We're not going to be looking to sell at this area. We're looking to see a push and break higher. So just similar with that BSX, we expect this breakout through 108 in time, but there is a trade right now to buy up through 100, which we're in, and potentially taking profits at 108. Just like with Walmart, we're expecting that breakout through 104, but there's been plenty of times to buy into support, sell into resistance, and make some money until it's really ready to go and break out to new highs. Again, Roku, we've been talking about pretty consistently each week as this base continues to set up. Again, 200 days continuing to catch up as well. Earnings are out of the way, so just let it keep setting up. Again, still a pretty wide range. The real out is really kind of versus 90. So one, just to keep on the back burner and just be ready for when this major break of this base is going to happen. Another one to keep on the radar is this SoFi. Again, we like these breakouts through all-time highs, these IPO highs, which we can see, starting to break out here. Again, still very wide. You got resistance at 32, you got support at 24. So still a bit wide here, but a name you definitely want to keep an eye on, because once it really clears this area, path of least resistance is going to be much higher. Next up, we have Regeneron. Again, this name has been very weak for the past year or so. And this past year started to base out, and on earnings, nice reaction through the resistance area of this base. Again, 200-day was acting as resistance the whole way down, and finally is starting to act as support recently. So earnings are out of the way. Nice little tight earnings select forming. Still a bit early. Today was technically like the retest area. So let it continue to set up between, this 620 and 660, and then just be ready for this breakout in the short term for a move back to like the 750 area as the 200-day continues to act as support. We got this TJX that started to break out today. This is one of Joe Lockhart's ideas from a few weeks ago. So just starting to break. We can see very textbook bull flag if you're in it already. Keep that risk a little bit tighter. Buy 145 versus 143. $2 risk here, less than 1%. Definitely a nice breaker to see, and you have earnings in about 10 days. Just want to make sure you get out before that. Next up, we have this EDU. Again, some of these Chinese names have started to wake back up, and we've had this massive base that's been forming all year. Now, we had that breakout of this base. Darren was one of the members who took advantage of this. It has since pulled back into the base, and this is something very common we see with key breakout areas, is you get that first pop, and it fades back into the range, and this is what we refer to as like this sneaky buyback. So the breakout goes, this is when most traders are hawking the name, so to speak. It comes back in, starts to shake traders out, coming back to the entry level or near the technical out, which it had done that into Friday. Again, 200 acting as support. And now here's when it starts to set up again in a much tighter range where you can get that next trade in it, but you're not looking to sell here. You're looking for that much bigger break. That's something similar to BSX, buying it through 100 this second time after the breakout as it comes back in. And I'll go back to that chart just to show. So you have that break of the base, you have that initial run up, it comes back into the range, forms a nice higher pivot low, and you have a much more defined, tighter risk entry. Even Budweiser was another name where we had a trade through support, through resistance. We took profits into the resistance near the 200-day. It came back, shook out that level, and it's now pushing back higher. Now, we're not in Budweiser because consumer staples were getting extremely weak during this period, but this is that move. It comes back to the level, shakes out, and then pushes higher than those previous highs. It's not like it runs back to the 62 and can't go higher. It pushes higher. So that's like for Walmart. When that breakout happens again through 104, we're not expecting that push to here. We're expecting that push higher. Same with BSX, this little sneaky buyback. We're not looking to really take profits here. We want to see that push higher. So that's with a lot of these sneaky buybacks like EDU. As this tightens up here in this like $3 range, when it breaks back above 56, the target isn't 61, the target's 68, 70. You want to see new highs through this move because you have much tighter risk. It's much easier trade that second time around. So a lot of sneaky buybacks setting up lately. Again, this Snap-on Tools, industrial name. We've been talking about the strength in industrials recently. Big base that's been forming. Keep an eye on this 347 area versus, we're going to still call it 340, but really 377. So about $10 risk in that name. Another one is we have Vive, very nice earnings flag that's been setting up for 2 quarters now. We have earnings coming up in about 10 days. So there could be a chance that, it's an opening range breakout candidate, meaning that nothing really significant happens in the name over the next 10 days. It probably trades within this range, this 280 to 310 area. And earnings is probably going to be what takes this name out of this big flag. So for now, if you can take the trade for 297 versus the 284 low of day, maybe we get a pre-earnings run up, and then you just aim to sell it before it reports. If not, just wait until after the earnings and find that opening range breakout. Again, we talked about financials before being somewhat weak broadly, but again, the key thing is just seeing that shift from that breakout stage into the consolidation stage, which is what we're starting to see with those financial names. So SFY, again, financial name, you can see a very clear breakout stage, which virtually every stock has been in since those March lows that are hard to even remember. But we have this massive breakout stage, and then financials just need time to settle out. They have to consolidate that move and form a very textbook bull flag. So we have a much broader range. We have a bit of a tighter flag forming here. So through 76 looks great. Earnings out of the way, 200 days catching up. All good signs, but it's just still consolidating. So you need to wait for the financials to base out and start to break back out. And then we'll see a lot of these financial names playing catch up. So Court, again, it's been on the radar for quite a bit. We had our eyes on that 75 level. Again, the earnings day really took that trade away. It just, was up so much off the open to you couldn't really chase an entry. Still setting up first that level. Again, for now, you have this very, very wide range in the name. So needs to tighten up a bit more. But one of Kevin's top ideas, massive base, looks great. Just need to let it develop a little bit more. So those are some of the top ideas for the week ahead. Briefly, I want to touch on just some lessons from 2008 with some of the financial names. One of our members was talking about Citigroup, and again, big run up, textbook bull flag forming, but this name is the worst. And the reason for that, again, this flag looks phenomenal, But we're going to zoom out when it actually changes to a monthly. And this is why, personally, I will never touch this name, because this is pre-financial crisis. Going into 08, financials were the strongest, sector in the market. Financial crisis happens, banks get destroyed. Citigroup lost, 90% of its value during that crash, and they killed the stock in 2011 when they did a forward split 1 for 10. So back then, Citigroup was trading at, $3, $4 a share. They do a forward split to prop it up, the opposite of what names like Tesla or what Netflix is doing next week. Netflix is splitting the stock to make them look cheaper, which is, not the time you ever want to buy a name when they're splitting the stock, because it does nothing to the company. So when Netflix splits, I have this vertical blue line drawn. Netflix is making their stock look cheaper after an insane run up, 500% run up since 2022. They're making their stock look cheaper. This is an avoid in the short term, because the only people buying Netflix post split think it's cheaper when nothing has changed. But this split to make the stock look cheaper is okay, just not the best thing in the short term. Now, when you try to make your stock look more expensive, which is what Citigroup did back in 2011, it kills all the investors who own the name before that split. Because if you own Citigroup back in 08, when it was really trading at $60 a share, when they do that forward split, you now need the thing to get back to 600 to get back to even. So Citigroup split adjusted really is a $10 stock still. And this is why, even though it's starting to get above the 200-day after nearly 20 years, it's a massive avoid, because everyone who's owned Citigroup pre-financial crisis that's still staring at a 90% loss, they cannot wait to sell every time this name inches up. And again, take a zero off. So Citigroup is really at $10 right now. So this is why I would never buy Citigroup or trade Citigroup or invest in Citigroup. This is the same reason why, even with Bank of America, it's taken them 20 years to get back to their 08 highs. So this is why, with those names, again, you haven't been trading for 20 years. It's hard to remember that, but I remember buying Bank of America and Citigroup during those times and watching Bank of America go to $5 a share. So if you are still in, you're creating massive resistance here that's going back 20 years. It's going to take a long time for this thing to get above those highs. It's going to take Citigroup probably another decade, where names like Goldman Sachs, who didn't do that, didn't have to split the stock, and they kind of rode out the pain. You can see what these names have done since. This is the 08 highs. Took many years to get back above it. Took nearly 15 years to really get above and break out of those 08 highs, but they've since gone on major runs. Same with even this BK was another name that a member mentioned earlier today. They're looking at a breakout in it through these all-time highs, but same thing. Bank of New York Mellon did not have to split their stock during 08. They weathered out the storm, and earlier this year had that blue sky breakout through that key level and has since appreciated very well since then. So this BK today is starting to break out, and I would take this BK 100 times out of 100 over the Citigroup bull flag, because this is effectively a $10 stock. BK is a real $100 stock. And these are just little things that, when you're around long enough, why Citigroup is, still down 90% from where it was back in 08. So that's just a little bank lesson on some names of why we avoid them, other names why we want to focus on them. Again, moving on, just some other names that members have mentioned recently. Again, AMD. I'm just going to give some broad recap of these names and if there's any particular trades in them. So AMD, after that AI announcement, this 200 has really been the key out in the name. Again, earnings are out of the way. If you're still in this name before that gap up occurred, this is your kind of line in the sand to stick with this winner. Oscar was a trade idea from a member who was looking to buy this into support right around here. We helped them avoid that trade, just saying wait for the 24 breakout. You don't really want to be chasing these names as they're coming perfectly into support. Again, when a name comes into support, you want to be able to barely buy it and it's gone. If it's hugging there or hanging around at support, it's usually going to break lower, just like with the markets. Market broke down its support on Friday, closed strong. It got away from support as quickly as humanly possible. And today it's gapped, and today it gapped up. That's what you want to see into support, where you don't have the time to wait to think about buying it. The buy is already gone. You got to buy into that weakness. You get bailed out today. That's the support buybacks you want to see when they hang out at support for a couple of days and you can get that exact price that you want to buy. It's going lower. And for this member, he did not buy it because we showed him just wait for that breakout. And he avoided what is a 25% drop in a couple of days. Another reason why I avoid these cheaper names. And when I refer to cheap, I mean anything under $30 a share. So this name, cheaper name coming into support, this is why it's an avoid. Week of trading and you're down 25% and really nothing happened other than earnings. So this is why we avoid names coming into support that are breaking support, why we avoid cheaper names, and why we try to avoid anything that has to do with holding through earnings, because this is a massive loss in just a week of a mistake. We had another member who, again, does not want to, wanted to do the same thing where they bought this cheaper name. Again, the complete opposite of what we teach. This is a member that just started. And if he had started a little bit sooner, we could have helped him avoid this particular trade where he is still down, 20+% in a couple of days. And this is, again, why we focus on teaching our newer members without it putting money in the market. So before he joined, he bought bull at $12 a share, and it's since dropped to 10. He's down 20% very quickly. And it's these cheaper names. That's where, really nothing significant intraday has happened with this name, no major news, but cheap names get cheaper. This name is down 90% since it came out. And you look at, Hood, its competitor, names at all-time highs. So this is where when you try to buy like the D-list player, instead of buying the winner, these are the things that happen. And this is why we want to educate members before they start putting money into the market, because this person put a significant sum into this name and they're down 20%. If you had 100 grand in this name 2 weeks ago, you got $80,000 today. It's not a fun place to be in. This is why we avoid these cheap names. We avoid names near 52-week lows, and we avoid newer issues that are, losing significant percentage of their value. So moving on to some of the, names that have been, doing quite well lately. We have this BE. I know Raheem's been in for quite a while. Again, key out really is this 120. Just keep letting it set up. Zoom, earnings coming up pretty soon. We have a big base break. It's been setting up for a couple of years now through this 88. We're recording this video on Zoom as we speak. So 88.90 key base break area. Probably still needs a little bit more time, but keep an eye on that one. Again, last week we had all the FANG names reporting. Again, not really any really blockbuster moves. You had Apple with a tiny gap up and just kind of, trying to flag out here. Again, expecting a breakout in time through this 280 area, but big range still. Probably has to kind of fade back into here a bit more as the 200-day catches up. Microsoft, a little double bottom here. We got this like 490, 500 area acting as support with 550 as resistance. So big 10% range. Whenever this breaks 550, expect to move to 600. That'd be a 50-point break out of this range. Meta has been a little cooked lately. We were talking to a prior member about this name and why You don't want to be buying the stage 4 breakdowns. Again, Meta, super strong broadly, phenomenal name, but very short term, very recent, just been in a stage 4 breakdown. So just got to let this name continue the path it's been on, which this is just somewhat of a downward trajectory in the short term, very clear breakdown stage. You let it base out and you find that next entry, which again, we've seen Meta go through these periods, is no, real shocker when Meta gets into these breakdown stages, what it wants to do. So you got to let these things run its course and wait for the break above the 200-day, wait for these times. It's much easier to buy the break of the breakdown stage than to buy into it and sit through this pain. And this is one where, again, 800, same as this last time, 800 to 450, why can't it do the same thing again? And that's why you don't really want to be chasing this on the way down. You want to let that base set up and buy on the way back up. Much easier. Again, Google, super strong. We were talking last week about, why we focus on names at all-time highs. This was a big all-time high break, and it's just continued to push higher. So we try to focus on. Again, very strong here. Like Apple, though, should expect some type of flag to form, just like we saw right here. When the name was at highs, it flags out for a couple of weeks and then goes on the next run up higher. So expect this to continue to flag out underneath this kind of 292 area versus 260 and just wait for that next breakout. Netflix in the short term, again, as we mentioned before, split their stock on the 17th, 10 for 1. So it'll be, $100 stock. Again, massive avoid post split for at least a month. I have this blue line here showing when that stock split is going to come into play. So we've seen Tesla, we've seen Apple, we've seen a lot of these names do these splits. They split the stock after extreme run-ups, which Netflix surely has gone on, nearly a 10x run-up since these 2022 lows. So these are big avoids in the short term from the active side when it comes to trading these names. So Netflix, big avoid. This team, again, been a very popular name with traders lately. Again, this blue line here just visually showing the easy versus the hard times. So you have the easy run up here, nearly 100% run up. We've seen it, this kind of whole way up. It goes on these massive runs, and then it has the same subsequent painful kind of pull-ins. We're seeing that same thing happening in team now, where it's kind of just falling off a cliff day by day, and you want to wait until it's touching more of its more macro support. So team, again, has had these major run-ups, has also had equally painful pull-ins. Not the time you want to be trading names like this. Let it settle out, let it rinse out, and they're going to push much lower than you and I can expect. So just take this one off the radar for now. eBay got cooked into earnings. Again, we like to see when these stocks fill the gap, which it did. 200-day acting as support. No big shocker there. And massive 20-point range in the name. Again, definitely still need some time to develop here. But if you like eBay, wait for more of a pattern to form here. And down the road, you got that big 100 breakout. Next, we have this XYZ. Big flag was forming going into earnings. Again, why we avoid earnings. Had that big gap down, but when you see these gap downs and they get kind of bought back up, this tends to become major support in the name. So you have this major support at 60, big resistance up at 82, big range here. Again, going to need some time, but really, if you're going to trade this name, 60 is the out. So that's really it for today. Again, a little bit more of a quieter week, getting a little bit more of that little bounce back action from the slow 4% pull we saw from all-time highs being put 2 weeks ago. Expect, kind of run up back up into this range. Probably get some continuation tomorrow. Again, the key psychological resistance in the index is going to be 7,000. It's a big round number. would not be too surprised if we see a run up into that in the next week or two, and would not be surprised if we see some resistance form at that major big round number, just like we saw with gold. Gold was on a tear and it magically found resistance at $4,000 an ounce. Pushes a little bit higher for the people that chased the end of the move, but resistance was created at that big round number. Just like we also saw with gold, pretty much 3,000 an ounce, 320 an ounce, big round numbers. So expecting some resistance in the next week or two as we run back up to 700 in the SPY. And in the meantime, keeping a big eye on consumer discretionary names, keeping an eye on industrial names, keeping an eye on names in the REIT space. So keeping a very close eye, and of course, tech as well. So few key sectors setting up, very selective on the trading setups. And if you have any other questions or top ideas, put them in the comments below, and we'll go over them in the next chart talk.